Welcome to another chat with AVID. David Harple, Jack Arnold. Jack, good to see you as always.
Good to see you, Dave.
So if you're joining us, we're actually a little ways into July here, but we do want to give AVID's version of a semi-market update, what's going out there, not only in the U.S. stock market and markets abroad, but just in general. We feel like there's a lot of talk of a number of things. We believe there's three main themes, and we really want to address those and how they're playing a role into what the market has been experiencing and what it's doing. Those three themes are, in no particular order, inflation, speculation, and residential real estate. So why don't you kick us off, Jack, just a little bit about what's going on out there?
Yeah. So just as like the first half, like you said, we're a few weeks into July. So even these numbers are kind of outdated, but I did want to just kind of give some numbers to give you an idea of what some of the various markets have done year to date. Also kind of call back to another video we did towards the end of last year, really the last market update that we did. Talk a little bit about that. So the first thing is, as far as just like investment markets, I'll just give you some numbers. So these are year-to-date numbers. Again, this is as of the end of June. So this is actually a few weeks stale at this point. But we've got kind of international developed markets, which would be something like Western Europe, Japan, South
Large
Korea,
name countries.
typically. Yeah. Large developed countries. So mostly Western Europe, but also Japan, South Korea. And you've got emerging markets, which is up 8.91%, which is mostly the other Asian countries is mostly what it is, but also South America, some other emerging markets. So sometimes you'll see South Africa thrown in there, so things like that. But mostly it's the Asian countries and the in South American countries, and mostly it's going to be Brazil, Russia, India, China. Right. Those are the big ones that make up most of the index. Like I said, that's up 8.91% year to date. International developed, I don't know if I gave this number, but it's up 9.93. Not sure if I gave the actual number. And then you've got the S&P 500, which is typically U.S. stocks. Mostly, if you can slice and dice these things as much as you want. The S&P 500 is up 15.24% year to date. So that's your kind of market snapshot, kind of global stock markets. Over the
so in a nutshell,
half,
it's been so far, fantastic. And I think killer is a great way to describe it. I think historically, let's just pick on the S&P 500, which you mentioned, U.S.-based stocks, historically has done about 10 or 11% long-term, 10, 15-year averages. And I just saw a stat recently that over the last 10 years, it's been north of 15%. So it's really been on fire the last 10 years and over the last 12 months, even through COVID. I think 12-month rolling average, so if you look back a year, 1 year return is north of 40%. Yeah. So it's been pretty amazing.
Yep. 40.77. So in 1 year. Obviously COVID's in there. It was kind of down quite a bit. But 40% a year is ridiculous.
Right. And I think, some of that is to reiterate that, 12 months ago, we're in the mid of summer. COVID has really been setting in. I don't think businesses had been opened up really, call it by the end of June, or maybe they were starting to. I don't think any one of us would have said, well, 12 months from now, U.S. stocks will post 40 plus returns. So
yes,
in the moment, it's hard to know. And anything could happen. Like you said, we're now pushing the end of July. We still have a good 5 months of the year remaining. So anything could happen.
Yeah, anything can happen. Yeah, and even those numbers, if you just annualize those numbers, they're crazy returns. Obviously, 40% for the last 12 months is crazy. But, you mentioned COVID. Completely unexpected, like who knows what the next thing will be.
Right.
Is it a global thing? Is it, I don't know, maybe it's something specific to just U.S. stocks. I don't know. These things are somewhat unpredictable. Stocks are volatile. They go up and down. That's kind of the cost of investing in stocks, is you kind of have to pay the toll of just dealing with the ups and downs and the volatility of the market. So, you get 40% up in 1 year, the trade-off is, it can go down 30% in a month or something. Right. Like that's just kind of that's the trade-off. So something to keep in mind. But in a general sense, I mean, stock returns have been great for the last 12 months, and certainly year to date, there's just, I mean, really nothing to complain about at all. So we'll see what the next 6 months hold, but I would say it's so far been a good year.
So far, it's good. I think it's interesting to think of, if you think those figures, 15% and 40%, and tying that into one of the themes here of speculation, we've heard people say, yeah, I just can't get that much in the market anymore. I'm going to do something else. And you throw into there whether it's Dogecoin or AMC or any one of those speculative, pure risk, not that it's a negative, but it's definitely not the kind of buy and hold or Warren Buffett philosophy, if you will, to investing. So it's been pretty wild.
Yeah. Yeah. I would say that, I mean, probably since like COVID, but definitely the last 12 months, certainly the last 6, even some of those things that you mentioned, I guess the last few months in like AMC stock, they've kind of fallen apart. But you have seen, I guess some of the speculation has cooled off, but I would say the first half of the year was all about just things, just like, speculation in the sense that there's no real tie to, I think this is a great company and I just love it for the future of the company. Some of it is just, I don't know, it's going up, so I'm going to buy it. I'm talking about on the internet, I'm just going to buy it because everybody's buying it. It will go up. I guess it's a little bit more akin to gambling, which is not, necessarily good or bad, I would say. I just think you need to know that, you're gambling. That's what you're doing. That's what you're getting yourself into. You can have great streaks in gambling and you can just fall apart.
Yes.
There's nothing to say, I think this was a good investment because XYZ. And I'm just kind of, if it can go up, you said 40% in the last 12 months, some of these things have gone up 40% in a day. For sure. They've gone down 50% in a day. They're just kind of all over the place. It's just to be, aware of the
just
game
mindful
that you're playing. Yes.
Yeah, it's not a right or wrong. Going to Vegas and gambling is not a right or wrong. Just know that you're playing the house, and normally the house wins. And the stock market, if I'm buying and selling and day trading, that's fine. But I'm going against some big people out there, and at the end of the day, company values will tend to shine through at the end of the day. But it is interesting to watch even, Elon Musk making a tweet and Tesla shoots through the roof in a month.
Right,
so
yeah.
You just got to be mindful of the environment. Speculation has definitely been a big thing so far this year.
Yeah, things that were like the Dogecoin thing is interesting, but something that was made up as a joke. It's just out in the open. It's meant to be a joke. It's just thought, people are buying it and it's, it's going up 1,000% and down, all these ridiculous amounts. So again, just to keep nailing the point home is you got to know the game that you're playing. I wouldn't recommend to say, this is my retirement strategy, but if you're taking, $1,000 and you've got a $500,000 portfolio, it's just not going to make or break you. But if you want to have some fun, sure.
Right.
Go ahead, I suppose.
Yeah. Just be mindful of it for sure.
Yeah.
Let's talk a little bit about residential real estate, because we've also seen those numbers and we've done multiple chats now on real estate, whether it's refinancing, should I sell my home? 3 or 4 of them I think we've done. Let's just talk about that, because it too is an environment that has been pretty abnormal. House values are going up. They still seem to be going up. And what do we, what happens next?
It's been pretty crazy. I think it's pretty generalized. I don't think it's a market to market thing. It seems as though it's all over the place. So it's not just something that's happening in, Las Vegas or Tampa or something like that. It seems pretty widespread across the board. Housing prices are, some places are up 50% in a year, which is crazy. So, what does it do to? Is that a permanent state of affairs? I can't really say. Most of the time when we're talking about real estate, we're talking about residential single family homes mostly, from a personal finance standpoint and a financial planning standpoint, not from a investment standpoint. However, most people's net worth is tied up in their home, which is we've probably mentioned this before. It's, is that good or bad? I don't know. That's probably a whole nother video and a whole nother discussion, but it is what it is. That's the truth of the matter. Most people's net worth is tied up in their home. It tends to be their biggest investment, their biggest expense. So you can't really ignore when things are going up and down so much in the residential real estate market. I would say I would be a little bit cautious because in a general sense, residential real estate, or any real estate for that matter, is going to be dependent primarily on the growth of the economy. And when it comes to like single family homes or residential real estate, it is going to be dependent on the growth of the local economy.
Yeah, community. What's around you? What's happening?
Right. If the local economy, let's say, your region, however you want to define that, is doing well, then the price of housing will typically go up at whatever that is. If their local region's growing at 5%, you would think the prices of your homes would probably grow about that. It'd be hard for the price of housing, let's say, to go up much more than that for a long time, only because it doesn't really do anything productive. It doesn't produce anything. It consumes.
Correct.
So it can only grow as fast as its local economy. If it's growing faster than that, eventually it will kind of just collapse under its own weight because it will become the economy and it doesn't produce anything. So it can only grow so fast. If you're getting, let's say from a national standpoint, if GDP is 2%, housing prices can't grow at 5% forever. Otherwise, they would just be the economy and they don't produce anything. So it can't really do that permanently. I do think you can circumvent that a little bit. One, locally, maybe some COVID, kind of remote work has a little bit of broken that tie. I think that's probably overstated. I still think the local economy is going to drive most of the price gains. But also, if you lower rates really, really low, if you think it's like a bond almost, if rates go really, really low, the price goes high just because people can borrow more nominal dollars for cheaper.
I can buy more. Exactly. I can take a larger loan out. My payment's smaller, therefore I can buy a home. And necessarily, if I pay an extra $50,000, it really isn't a whole lot when it's 2.5-3% interest rate a month. The monthly payment is a smidge, and that's what a lot of people. That's a lot of the way that we look at it. What's the monthly payment? Yeah. So I'm hearing you right.
People buy houses based on monthly payment. And then as soon as you buy it based on a monthly payment, the only thing that matters to you is the nominal value. But the nominal value is only somewhat a proxy for what's the monthly payment, what's the mortgage payment that somebody could pay. If rates doubled, people can't pay that much. Naturally, that would affect housing prices. Of course, the opposite is true. They go even lower. The only issue is they're pretty low. There's not a lot of room to go to make long-term mortgage rates a whole lot lower. This isn't like mortgage rates in the 80 that were 15% or something, 10%, whatever it was. There's a lot of room for it to go down, but we're kind of at the lower bound at this point on a 30-year mortgage. I guess you could say it could go to zero, but we're getting pretty close to. There's not going to go. You can't rely on lowering rates to be able for people to be able to afford even higher nominal prices forever. And then the second thing being. The second thing being that restricting supply. So if you have zoning rules and all these different things where it just restricts supply, you don't allow people to build anything new, it will cause, it's a supply and demand issue, I suppose. It will cause the prices of something to go up. There's more demand than there is supply. But you can only restrict supply for so long before you start to get societal issues. You can't just say nobody else can do anything just to keep it. That's just an artificial. So eventually, again, that would just collapse under its own weight. You get all kinds of societal problems. You're seeing that already a little bit. I just don't think those are things you can rely on going forward to continually increase the cost of housing indefinitely at this rate. Right. It's just going to be hard for that to continue.
Yeah, it ties back to the speculative investment. Like, there's nothing wrong appreciating the value of your home. Maybe even you sell it, you capitalize it. Again, it's a different chat and video, but just don't rely. Our advice would be don't rely on the value of your home for retirement, because it's gone up 8, 10, 15, 50% since I bought it, or since the financial crisis, which I think people have long forgotten about. It was only, 13 years ago. This is just going to continue, and therefore I'm going to bank on my house that's worth $500,000 being worth $2 million, and then I'll be able to retire. So
yes, and if it becomes a vehicle for speculation, it's a financial instrument, a vehicle for speculation. It will act like one. It will go up a lot and it will go down a lot. It will be much more volatile than it was, 50 years ago, just because it's become more financialized in some sense.
Yes.
There's a lot more options to financialize the value of your house, which in some cases is good, but in some cases it does start to introduce some of like market dynamics, booms and busts. I just think that will be a more frequent occurrence. I could be wrong. But that's definitely been a theme, definitely year to date. And I would say probably the last 12 months has been a big theme. It's just that wild increases in general housing prices for sure.
Yep. Let's talk lastly here about inflation. This is, I think, the third theme that's been out there. I just read a thing today about expectations have been beat, meaning inflation has spiked higher than anticipated. And of course, there's concerns with inflation that the cost of goods are just going to be too much, and it could cause a number of different issues, market related and otherwise. So I think you might have some stats on that as well. Yeah.
Well, so like I said, this is maybe a few weeks into July. I think about a week or so ago, we got a new CPI information. I think it was up 4% or something. Index. Yeah, consumer price index, like 4 to 5%. It was pretty high. This is going, considering that getting to 3 was like something that we've been wanting to get at for a while. It hasn't even been over 2 sometimes. To see it at 4 was was shocking. It was even higher than people expected. Is that something that is permanent? Like you're going to see 4 permanently? These are going to be kind of constant numbers. Prices going up 4%, 5% even is going to continue to go up. Or is it more of a, kind of what you've heard the Fed call it is it's more transitory, meaning this is more of a symptom of a reopening. So COVID, a lot of things shut down. A lot of supply was taken offline. It's gotten much better, much quicker than people anticipated. And now people are scrambling. So there's a ton of demand, not a lot of supply. Again, a whole supply and demand situation. So prices have gone up because there's a lot of demand and not a lot of supply. When more supply comes online, whether that's, used car prices has been a big part of it. Just used cars and new cars have been a big portion of it. And when those things, you would think those things will work themselves out over time as more cars, this whole chip shortage thing, as that kind of works its way through the system, does that start to tail off and you don't see as much of that inflation? So anyways, go ahead.
I just read a thing today from Homebridge Financial, a little piece that they put out. And you mentioned transitory. Leisure, hospitality, and airlines represented about a 5% increase in prices, which comprises about 90% of the whole value. The other 90% only went up 0.2%. So those are things coming out of COVID that we've definitely seen. Prices go up because now you can use it.
The reopening sectors, so travel, leisure, the whole used car things, these kinds of things have driven a lot of the increase. And it's what happens when those tail off. What happens? Does it go back to where it was before? So I don't know. That's one of those things you have to wait and see. The other thing is, most of us have not seen like a real kind of inflationary type of environment. It's not like we've had, anything
not
really
like the
high.
80s.
It's been kind of more of a disinflation type. Inflation was coming down for a long time. Talking late 70s, early 80s. So it's been a while. I think, I don't know that there's a whole lot of prescription as to what to do about it because it's kind of unpredictable in some sense. I mean, it's hard to really say. But at the same time, let's say that you had a booming economy, I think you would see a little bit more inflation, Like let's say that you did get a lot of, we were talking just before we got on here about, building 2 million homes or just the lack of housing that we have. Something was to change and you started getting a lot of additional building, a lot of, economic activity, like the infrastructure thing. Like a lot of that stuff starts to come through and you get a lot of building and like an economic boom, you would expect there to be a little bit more inflation. Is that bad? I don't know. I don't know. Would you be upset if GDP was 5 and inflation was 4? I don't know. Who knows? Like, if wages are growing at 6% and inflation is 3%, I would say that's pretty good.
Yeah,
know,
I think
if
you'd be
inflation's
happy.
6 and wages are 3, then you got a major problem. But
Right.
so in isolation, it's hard to say that it's a bad thing. I would say that it's dependent on other things. You know, you wouldn't want it to be 12, but you also don't want deflation. You don't want it to be negative too. So I think it's been a big story. I think it's becoming even bigger story in the last month or so. We'll see how it plays out. You know, one other thing to mention is if you were getting lots of inflation, kind of the market was expecting there to be a lot of inflation, what you'd start to see is rates going up. So you'd see interest rates going up because they would say, well, inflation's going up. I need to get paid more if I'm going to lock my money up. So like if you want to use like a 10-year Treasury as a kind of a benchmark rate, which is what a lot of people would use, you know, the 10-year Treasury 1.21%, which, you know, let's see.
It's pretty low.
Yeah, it's pretty low and it's going down. So,
Well, and they've recently said, even the Fed came out and said that there's no immediate reason to raise rates. They're keeping an eye on it.
The Fed hasn't raised
they tend
rates.
to be reactionary as opposed to proactive. So that plays a role too.
So it's up since July of last year. So let's say the last 12 months. So July 27th, it was 0.53. But like you mentioned, that was like in the teeth of COVID. So it was actually pretty low then, 0.53. Now it's, you know, what I say, 1.21, which is definitely higher, but it's lower than it was in March, was 1.7. And back in 18, which wasn't that long ago, it was 3.2. So it's still down from where it was. It's not like we've seen this giant jump in rates. Certainly not what you would expect to see if we were getting some kind of runaway inflation. You would see that. You would think you would see that going up quite a bit. So for now, you know, the bond market just doesn't seem to think that it's an issue and that this is transitory. It's something that's going to fade away. So we'll see.
So those are the three themes: speculation, residential real estate, and inflation. They're topics. They're important. They definitely have an impact. But I would say AVID's theme is let's not have them drive your investment decisions. Let's not rely on those things in the vacuum and short term to decide whether you should be invested or not. A lot more goes into it. And in the long run, we might look back and this will just be another one of those chats that we do. So
right, exactly. Yeah, we'll see where we are in 6 months.
That's right. Thanks for joining today. We hope you all have a great week and we'll see you next week.
See you, Dave.